One of the trickiest parts of planning for retirement is understanding how capital gains taxes can impact your income. You've probably heard that long-term capital gains are taxed more favorably than ordinary income, but how does that actually work in retirement? Can selling investments in your brokerage account trigger taxes on your Social Security? Could capital gains push your Medicare premiums up? Well, in today's video, I'm going to explain how capital gains are taxed and what every retiree needs to know to avoid tax surprises. I'm Kerry Green, financial advisor and co-founder of Green Era Financial, and I help people close to or in retirement to get the most out of life with their money. Okay, let's dive in. Capital gains are the profits you make when you sell an asset for more than what you originally paid for it. If you hold the investment for more than a year, that gain is considered long-term and gets favorable tax treatment. But if you sell it within a year, it's a short-term gain and taxed just like ordinary income. Now, typical assets that generate capital gains include things like stocks, mutual funds, ETFs, real estate that's not your primary residence, and even collectibles, though collectibles come with their own set of rules. On the flip side, if you sell something for less than what you paid, that's a capital loss, and losses can be used to offset gains, which we'll talk more about that later. Now let's talk about the tax rates themselves. Long-term capital gains have their own set of tax brackets, and they're generally more favorable than those for regular income. For 2025, if you're a single filer and your taxable income is up to $48,350, or $96,700 if you're married filing jointly, your long-term capital gains rate is 0%. If your income is higher than that, but still under $533,400 if you're single, or $600,050 if you're married, you're in the 15% capital gains bracket. Now, anything above those numbers, that's taxed at 20%. But here's something critical. Capital gains taxes don't apply to every type of account. If you're selling investments inside of a 401k, a traditional IRA, or even a Roth IRA, or taking withdrawals from any of these retirement accounts, these aren't subject to capital gains tax. That's because those accounts are taxed under different rules entirely. Traditional IRA and 401k withdrawals are taxed as ordinary income. Roth withdrawals, if qualified, are tax-free altogether. Capital gains taxes only apply to non-retirement accounts, like your brokerage account, a joint account with a spouse, or a trust account. Gains on investments held in those accounts are what trigger the capital gains tax when they're realized. Also, to be clear, your savings account doesn't generate capital gains. Interest from those is taxed as ordinary income, not as capital gains. So while capital gains are an important part of managing a taxable investment portfolio, they don't apply to retirement accounts or bank savings accounts. So it's entirely possible for retirees, especially those living off of Social Security, Roth distributions, or tax-efficient portfolios, to realize capital gains and pay no federal tax at all. But here's where it gets tricky. Just because your capital gains are taxed at a lower rate doesn't mean they don't impact your broader tax picture. Now, capital gains don't exist in a vacuum. They interact with other parts of your financial life, sometimes in surprising ways. So let's start with Social Security. Capital gains count towards something called combined income, which is used to determine how much of your Social Security benefit is taxable. Combined income includes half of your Social Security plus all of your other income. And yes, that includes capital gains. Even tax-free municipal bond income counts. So, if your combined income goes over $25,000 as a single filer, or $32,000 if you're married filing jointly, you could end up paying tax on up to 85% of your Social Security benefits. Next, we have the net investment income tax, or NIIT. This is a 3.8% surtax that applies to investment income, including capital gains, for individuals with higher incomes. For 2025, it kicks in when modified adjusted gross income exceeds $200,000 for single filers and $250,000 for married couples filing jointly. This is on top of your regular capital gains tax. So if you're in the 15% bracket and you're subject to NIIT, your effective capital gains tax could be 18.8%. This tax doesn't apply to income from wages or pensions, but it can apply to gains from selling stocks, bonds, mutual funds, and even from certain real estate transactions. Now, if you're in a year where you're realizing large gains, maybe from selling a rental property or rebalancing a sizable portfolio, NIIT can quietly sneak in and bump your tax bill even higher, and it's something many people forget about. Okay, now let's talk about Medicare premiums. If your modified adjusted gross income, or MAGI, goes over certain thresholds, you may face what's called an IRMAA surcharge. This is an additional amount you'll pay for Medicare Part B and Part D. And again, capital gains count toward that MAGI number. So one large sale, even if it's just a one-time thing, could increase your Medicare premiums for an entire year. Finally, there's something called the capital gains stack. This means that capital gains are stacked on top of your ordinary income when calculating your tax liability. So even if your base income puts you in a lower tax bracket, adding capital gains on top could push a portion of those gains into a higher capital gains bracket. In other words, the first chunk might be taxed at 0%, but the rest could spill into the 15% or even 20% range. Now, one of the more favorable rules when it comes to capital gains in retirement is the step up in basis. When you pass away, most of your assets receive a new cost basis equal to their fair market value on the date of your death. So let's say you bought a stock for $10 per share and it grew to $100 per share. If you sold it while you were alive, you'd owe tax on $90 of gain per share if this stock was held inside a non-retirement account. But if you pass it on to your heirs and they inherit it at a $100 basis, they can sell it immediately and owe zero capital gains tax. This rule does not apply to retirement accounts like IRAs or 401ks. It's mostly for taxable accounts. And it's why we often encourage clients to spend down tax-deferred money first and leave taxable assets for inheritance. The tax savings can be substantial. Now let's talk about capital losses. If you have investments that are down in value, you might consider selling them to realize a loss. This can help offset gains elsewhere in your portfolio. If you don't have enough gains to offset, you can deduct up to $3,000 of those losses against your ordinary income each year. Anything beyond that can be carried forward indefinitely. This strategy is called tax loss harvesting. It's something many retirees or their advisors implement toward the end of the year. But you have to watch out for the wash sale rule, something that's very important. If you sell a stock or fund for a loss and then buy the same or a substantially identical one within 30 days before or after, the IRS will disallow the loss. So for example, if you sell an S&P 500 index fund on the first of the month at a loss, and then you buy a totally different S&P 500 index fund, maybe the first one was from Fidelity and the second one is from Vanguard, and you buy it on the 15th of the month, then that could trigger, since it's substantially identical, that loss you originally realized gets disallowed. Before we get into specific planning strategies, let me add one more thing that's often overlooked: state capital gains taxes. Federal tax rates are only part of the picture. Depending on where you live, your state may also tax your capital gains. Some states like Florida and Texas have no state income tax at all, which means no state tax on capital gains either. But others, like California and New York, treat capital gains the same as ordinary income. That means your long-term gains could be taxed at rates over 9 or even 10% on top of your federal rate, often overlooked. This is especially important if you're planning to sell a large asset, like a business, real estate, or a very concentrated stock position. It may even factor into where you choose to retire or what state you claim as your residence. Now, let's talk about how to manage capital gains effectively in retirement. So, how can you use all of this to your advantage? Well, one way is to manage your income to stay within the 0% capital gains bracket. This might mean spreading gains over several years, especially if you're trying to avoid Medicare IRMAA surcharges or minimize Social Security taxation. Another strategy is coordinating your capital gains with other moves, like Roth conversions. If you're converting money from a traditional IRA to a Roth IRA, you want to be careful not to stack capital gains on top of that income in the same year. That could inadvertently bump you into higher tax brackets. Asset location also matters. High growth investments are often better suited to taxable accounts, where you can take advantage of long-term capital gains rates or loss harvesting. Meanwhile, income-producing assets like bonds may be better placed in tax-deferred accounts like traditional IRAs or even Roth IRAs in some circumstances. And don't forget about charitable giving. If you donate appreciated stock instead of cash, you avoid paying the capital gains tax altogether, and you still get a charitable deduction for the full value of the stock. And finally, long-term planning is key. Think about how your capital gains strategy fits into your broader estate plan. If you plan to leave assets to heirs, a step up in basis could mean they pay no capital gains at all. Capital gains are one of the most flexible and controllable parts of your retirement tax picture. But if you don't plan carefully, they can create ripple effects from higher Medicare premiums to unexpected Social Security taxation. But the good news is, with the right strategy, you can use capital gains to your advantage, whether it's through careful timing, tax bracket management, or smart giving strategies. This is one area where good planning really pays off. So, if you want help building a retirement income plan that makes smart use of capital gains, you can visit us at greenarrowfinancial.com or feel free to reach out to me anytime. I'm always happy to help if I can. Thanks for watching, and I'll see you next time.